FHA loans are the most common type of government-backed home loan. Similar to the VA and USDA programs, the Federal Housing Administration provides a type of insurance for mortgage lenders. That financial guarantee allows FHA lenders to make home loans to borrowers who have lower credit scores and smaller down payments. So let's take a closer look at FHA loans. The FHA allows borrowers with credit scores as low as 500 to be eligible, but most FHA lenders out there will require a higher score. They'll often have a credit score benchmark around 580. Now, in the grand scheme of credit scores and mortgages, that's still a pretty low score. But at the end of the day, like with any other type of home loan, benchmarks for credit scores will always vary depending on the lender you're talking with and more. Another bit of good news, though, about credit and mortgage requirements is that FHA loans tend to be more flexible and forgiving than conventional loans when you're talking about things like a previous bankruptcy, a foreclosure, or a short sale. Now, another benefit of FHA loans is that they require just 3.5% for a down payment. That's lower than the 5% that you'll need for most conventional loans, but it still doesn't beat the no down payment benefit of both VA and USDA loans. Now, buyers out there with credit scores below 580, they'll need to put down more. They'll need to put down at least 10% for an FHA loan, but again, that's assuming you can find a lender out there who's willing to go below that kind of credit score cutoff. Now, when it comes to closing costs on FHA loans, they also offer some benefits, some big-time benefits. You can ask a seller in an FHA purchase transaction to contribute up to 6% toward closing costs and concessions. Now, understand, at the end of the day, who pays what when we're talking about closing costs is always a byproduct of negotiation with the seller. Now, FHA buyers can also use gift funds to cover both down payment and closing costs. Now, this money has to have a documented paper trail, and it truly needs to be a gift. There can't be any kind of expectation that this money has to be repaid someday. Also, gift funds can't come from anyone involved in the purchase, like the seller or the lender. In terms of drawbacks, FHA loans come with their own forms of mortgage insurance. These are known as mortgage insurance premiums, or MIPs. Now, FHA buyers right now pay an upfront mortgage insurance premium of 1.75% of the loan amount. Now, this isn't cash that you have to come up with at closing. Instead, what happens is this fee is added to the total amount that you're borrowing. So that's the balance of your loan after you make your down payment. Now, on top of that, FHA buyers also pay this annual or recurring mortgage insurance premium. This cost is spread out over the course of the calendar year, and you pay it as part of your monthly mortgage payment. Now, how much you pay depends in part on the length of your loan term and your loan-to-value ratio. Now, for most FHA buyers out there, this annual mortgage insurance premium is right now 0.85% of the outstanding loan balance. This annual fee can easily add $100 to $150 or more to your mortgage payment every month. It's also a fee that most FHA buyers now pay for the life of their loans. Now, FHA also has loan limits on how much you can borrow. These vary depending on where you're purchasing and the type of property you're looking at. In most parts of the U.S., the loan limit right now for a one-family residence is just under $272,000. But there are absolutely higher limits in some of the country's more expensive housing markets, and these limits can change from year to year. Now, occupancy is also a big consideration with FHA loans. Like VA and USDA loans, FHA loans are focused on helping people buy primary residences, homes they'll live in full-time. So you wouldn't be able to use an FHA loan to buy a vacation home or an investment property. And last, and this is really an underrated benefit in many ways, FHA loans are assumable. That means that another person can effectively take over your mortgage loan, your interest rate, and your monthly payments. This can be a big benefit. So let's say that you buy a house when interest rates are low, and then a few years down the road, rates skyrocket. Instead of getting a new loan with a higher rate, a buyer out there could assume your current loan and take advantage of that low rate that you locked into years before. And that's a brief look at some of the benefits and challenges of FHA loans.